Hello and welcome to FINANGY, where finance meets strategy. Every year, companies announce cost-cutting programs using almost the same language. They say they are streamlining operations, improving efficiency, driving discipline, protecting shareholder value. The board approves it, the market often rewards it, and the leadership team feels like it has taken control. But very often, what looks like discipline in the quarter becomes weakness a few years later. The talent is thinner, the product is weaker, the customer experience slips, the company looks more efficient on paper while becoming less competitive in reality. That is what this video is about, not the idea that costs should never be cut. That would be simplistic. This is about a more important distinction: the difference between cutting costs and managing value, because one can improve a number, the other can strengthen a business. Here is how I want to frame the conversation. First, we look at why cost-cutting feels smart, especially under pressure. Then we look at the accounting illusion, how a company can appear healthier financially while quietly getting weaker underneath. After that, we move to three companies, Sears, IBM, and Amazon, because real examples expose the difference between reactive cuts and strategic capital allocation more clearly than theory ever can. And finally, we go into the framework strong CFOs use instead of reflexive cuts. So throughout this video, keep one question in mind. The issue is not whether costs should ever be cut. The issue is whether the business understands what creates value, what protects value, and what is merely consuming resources without improving the company. That is the real standard. Before we get into frameworks and case studies, it is worth grounding this in evidence. Bain & Company studied 3,900 companies across two major recessions and found that companies that kept investing through downturns often outperformed cost cutters by 3 to 5 times over the following decade. That is a powerful result. Not over one quarter, not over 1 year, over a decade. And that tells us something important. The companies that come out of difficult periods strongest are usually not the ones that cut the hardest. They are the ones that raise productivity where they should, eliminate waste where they should, and still protect or expand the capabilities that create future advantage. That is not the absence of discipline. It is a much higher form of discipline. So why does cost-cutting remain the default response? Because it has 4 characteristics that make it look exactly right in the moment. First, it is visible. Everyone can see the effect on the P&L. Second, it is immediate. Revenue growth takes time. Capability building takes time. Cost cuts show up now. Third, it creates the illusion of control. When the future is uncertain, cutting feels decisive. And fourth, it is easy to defend. Very few people in a pressured boardroom will argue against lower cost and short-term margin improvement. This is why the reflex is so common. The problem is that movement gets mistaken for strategy, and once leadership confuses visible action with intelligent action, bad decisions start looking responsible. The illusion of financial discipline. This is where the argument really begins. Because the deepest problem with cost-cutting is not that it lowers spending, it is that it often improves accounting before it improves economics, and sometimes without improving economics at all. This is one of the central ideas in the deck. When a company cuts costs aggressively, the financial statements usually look better very quickly. Operating expenses go down, EBITDA margin improves, free cash flow rises, EPS looks stronger. The reaction can even be positive externally. So if you judge the decision through the narrow lens of short-term financial reporting, it can look like excellent management. But that is only half the picture. Because while the statements improve, the business may be losing things the statements do not measure directly. The revenue pipeline may be weakening. Talent quality may be declining, product competitiveness may be eroding, brand strength may be fading, and competitive position may be deteriorating silently. That is the trap. The accounting system measures cost. It does not measure capability. And once you understand that, you realize why so many cost decisions look smart before they prove damaging. Now let's make that more concrete. The capability destruction clock is a simple way to show the pattern. Cut marketing and EBITDA improves now. Later, the pipeline weakens and revenue pressure builds. Cut R&D and profit lifts immediately. Later, the roadmap stalls and market share starts moving elsewhere. Cut top talent and payroll drops right away. Later, attrition rises, execution suffers, and rebuilding becomes expensive. Cut customer service and operating expense falls. Later, churn rises and customer lifetime value starts deteriorating. The logic is consistent across all four examples. The benefit appears first, the damage arrives later. And because the damage is delayed, leadership often credits itself for the early improvement and fails to connect the later decline to the earlier decision. That delay is one of the biggest reasons bad cuts survive internal scrutiny. There is another dimension here that deserves more attention. It can take years to build a real capability, a strong team, a trusted brand, a differentiated product, a customer engine, a technology platform that creates structural advantage. Those things compound slowly, but a single restructuring decision can weaken them very quickly. That is the asymmetry. 3 to 5 years to build, one board meeting to damage, and once the capability is weakened, rebuilding is almost never as simple as restoring the budget later, because time passes, people leave, competitors move, customers adjust. Cutting is easy, rebuilding is exponentially harder. Now let's move to the case studies. 3 companies, 3 outcomes. This is where the difference between reactive cost cutting and strategic capital allocation becomes impossible to ignore. Sears is one of the clearest examples of what managed decline looks like. In 1997, Sears was America's largest retailer, a dominant brand with enormous scale and institutional presence. By 2004, cost programs were underway. Stores were closing, staff was being cut, investment was being reduced. Then came 2008 as Amazon accelerated and the retail landscape shifted more aggressively. Sears continued reducing investment in competitive capability instead of rebuilding it. By 2013, the gap had become obvious. Revenue had fallen sharply, and by 2018, Sears filed for bankruptcy under roughly $11 billion of debt after thousands of store closures. The lesson is not simply that Sears cut costs. It is that the numbers looked disciplined while the business was steadily losing its ability to compete. That is exactly the danger this video is about. IBM gives us the counter-example. In 1993, IBM lost around $8 billion. The board considered breaking the company apart. Analysts pushed for aggressive cost reduction. The pressure to act was enormous, but their new CEO, Lou Gerstner, did something very important. He did not assume that the cost structure itself was the core problem. He recognized that the deeper issue was strategic, so he rejected the breakup. He expanded IBM's services model. He redirected R&D toward customer-relevant solutions, and he removed redundancy while protecting core capabilities. That distinction matters. IBM did not avoid discipline. It applied discipline selectively and in service of a bigger repositioning. So yes, costs were cut, but the cuts followed strategy. They did not replace it. The result, IBM's market value rose from $29 billion to $168 billion, and the stock price by 8x during his tenure. And that is why IBM's turnaround is such an important example in this conversation. Amazon represents a very different model again. During the 2008-2009 downturn, while many companies were focused on cutting back, Amazon kept investing in AWS, Prime, fulfillment, and long-term infrastructure. That mattered enormously. AWS became the infrastructure base for a massive, more than $90 billion business. Prime deepened customer loyalty, and fulfillment became a structural cost and service advantage that competitors spent years trying to understand, let alone match. What Amazon understood was that downturns are not only periods of risk, they are also periods of strategic opportunity. When others retreat, the cost of building advantage often becomes cheaper. So Amazon did not win by cutting deeper. It won by building structural advantage while others were defending the quarter. This leads to a broader principle. Structural cost leadership is designed. It is not squeezed out of a business through endless reductions. The strongest cost positions usually come from better operating design, smarter use of technology, more automation, more simplification, stronger process architecture, and greater scale efficiency. In other words, the best cost leaders are not always the companies that spend the least. They are the companies that design systems that deliver value more efficiently and more consistently than others. That is a much better form of discipline than repeated rounds of cuts. Cutting can shrink an expense line, but design can lower the cost of delivering value itself, and those are not remotely the same thing. Now, let's talk about the CFO's discipline. If reactive cost management is the weak version of finance, this is the stronger version, because the best CFOs are not just budget controllers, they are capital allocators. And capital allocation is where financial discipline becomes strategic discipline. The first framework is the cost portfolio framework. A strong CFO should think about cost structure the way an investor thinks about a portfolio. Not every cost is equal. Not every dollar has the same return profile, and treating all spend the same is one of the fastest ways to weaken a business. The first category is capability capital. This includes marketing and brand, R&D and product, engineering talent, and customer relationships. These are compounding assets. If managed well, they create future advantage. Cutting them blindly is often the same as selling the future at a discount. So the rule here, protect and increase when competitors cut. The second category is operating infrastructure. This includes finance systems, HR, IT maintenance, facilities, and supply chain operations. These should be optimized relentlessly, but the goal is efficiency, not indiscriminate reduction. The rule for this category, streamline and invest in automation where ROI is clear. The third category is organizational friction, legacy systems, duplicates after mergers, unused programs, bureaucratic overhead. This is where aggressive reduction is often correct. So the discipline is not to cut everything. The discipline is to know what compounds, what should be optimized, and what should be eliminated. So the rule here, OS cut aggressively and reallocate the capital to higher value uses. The second framework is a decision architecture. Before any cost reduction is approved, it should pass through three filters. First, does this cost build or protect competitive advantage? If yes, it deserves serious protection. Second, can the same capability be delivered more efficiently? If yes, optimize it, redesign it, automate it, improve it, but do not destroy it. Third, is this cost intentional by design or has it accumulated by default? If it is entropy, duplication, drift, complexity, or organizational residue, then reduction may be the right answer. This structure matters because it slows the reflex. And most bad cost decisions happen precisely when leadership moves too quickly from pressure to action without properly diagnosing the nature of the cost. The real question is not, can we cut this? The real question is, what problem are we actually solving? This is also why tools like zero-based budgeting are so often misapplied. The problem is rarely the tool itself. The problem is the scope and logic behind how it is used. If it's done badly, ZBB becomes a blunt target exercise. Everything is forced to justify itself. Capability capital gets treated the same way as friction. Teams are asked to defend mission-critical work as if it were optional, and the result is predictable: weaker weaker morale, weaker investment, and a structurally thinner business. However, if it's done well, ZBB is much more selective. It focuses on friction, it identifies entropy, it protects capability capital, and it explicitly redirects freed capital toward higher value uses. So the lesson here is simple. Strong finance does not weaponize budgeting. It uses budgeting to sharpen allocation. Now, to keep the argument balanced, let's be precise about when cost reduction is the right move. There are at least 3 situations where it is strategically justified. The first is post-merger consolidation. When 2 organizations come together, duplicate systems, overlapping roles, and redundant infrastructure often create genuine waste. The second is strategic exit from non-core activities. Companies often continue funding businesses, products, or initiatives that no longer fit the strategy. Cutting those is not weakness, it is focus. The third is structural redesign for efficiency. Sometimes the operating model no longer fits the business reality. In that case, the answer is not to trim around the edges, it is to redesign the engine. So cost reduction is not wrong. Reflexive cost reduction is wrong. That is the distinction. Let me summarize the philosophy in 4 principles. First, capital allocation is the CFO's primary job. Second, costs are not the problem. Misaligned costs are. Third, the time horizon determines the decision. Many cuts look smart in 1 quarter and destructive over 3 years. And fourth, the best time to invest is often when competitors are cutting, because that is when structural advantage is most available to those with clarity and conviction. These principles are not abstract, they are the operating logic that separates reactive finance from strategic finance. So here is the central distinction in its simplest form. Cost cutting asks, how can we spend less? Strategic capital allocation asks, how can we create more value per dollar deployed? That difference changes everything. Sears cut its way into irrelevance. IBM repositioned strategically, then aligned costs behind the strategy. Amazon invested through the downturn and built advantages competitors could not easily catch. This is why strong companies do not manage costs only as a number. They manage them as a portfolio of choices, trade-offs, and future consequences. And over any meaningful time horizon, that approach wins. The discipline is not in saying no to spending. It is in understanding what creates value and having the conviction to protect it even under pressure. That is the job, not simply reducing budgets, not simply defending margins, and not confusing visible action with intelligent action. The strongest finance leaders are the ones who know what their business must protect, what it must improve, and what it must stop doing altogether. That is how enduring businesses are built. This is FINANGY, where finance meets strategy. Thank you for joining this session. See you in the next one.